Sure, Pawan. So, within infra, there is another segment which is being talked about a lot, which is defense, which has been kind of, I would say, talk of the town in, stock markets these days. What are your views in terms of, is it at a still an opportunity stage in terms of we expecting a lot of returns from here, or maybe a stage from where, one should kind of stay away?
I'm extremely happy to see defense getting its due share, Kamal. I've been a very early investor into defense segment as a private equity investor since 2001. So I've seen this space coming up very, very up close and personal. There indeed is a fantastic opportunity to play out in the defense, more particularly in the private sector where people are looking at export as a big opportunity coming up. Having said that, the recent sentiment-driven and liquidity-driven kind of stuff which has happened in a lot of those defense stocks has taken the valuation to another level. And that's something that we find it a little uncomfortable to pick up these stocks at the current levels. Because if you look at it, the entire pack is trading anywhere between 50 to 100x or maybe even beyond that. And having been an early investor into this segment, the experience is that while the order books are there, but execution takes time for multiple reasons. One, because there is physical challenge and limitation to how much can be executed. These are not, stuff that can be printed overnight and can be supplied. So there's a lead time for doing that kind of precision engineering and everything else. And you cannot do beyond certain point, even if you have all the other stuff being available to you. So there is a challenge in terms of execution. And from our perspective, we generally look to buy into businesses which are trading at less than 1 PG, which is price to earnings growth ratio. And that's something that we are unable to figure out that whether these companies will end up reporting, a 60-70% kind of a CAGR over the next 2-3 years. Because if they indeed do so, then probably the current valuations could be justified. But if not, if the growth were to be truncated at even 15, 20, 30%, then I'm not sure how long-term wealth creation can be done at these valuations.